In our strategy, we use a 5-phase cycle framework. We are not trying to predict events or time markets. We focus on how structure and behavior change risk over time. That is how we stay oriented late in the cycle. One of the most dangerous conditions in markets is not stress or volatility, it is calm. This framework explains why stability often carries hidden risk. This episode is based on a builder's lens essay on Hyman Minsky's financial instability hypothesis. It is a conceptual framework, not a market call. Our role is to translate it into our strategy lens. Minsky's insight was behavioral, not mathematical. When conditions stay stable for long periods, people become more confident, and that confidence changes how risk is taken. As stability persists, risk feels lower than it actually is. Borrowing increases. Financing structures quietly shift. In early cycle environments, borrowers can service both principal and interest. Cash flows cover obligations comfortably. Risk remains contained. As cycles mature, speculative finance expands. Interest can still be paid. Principal must be rolled forward. Refinancing becomes essential. In the final stage, cash flows no longer cover obligations. Asset prices must keep rising. Fragility is now embedded in the system. Crises feel abrupt, but the conditions build slowly. The trigger is not panic. The trigger is failed refinancing. In our strategy, Minsky maps cleanly to phase sequencing, not timing, vulnerability. After a crisis, leverage is low. Risk aversion is high. Hedge finance dominates. Memories of instability are still fresh. Phase 1 is where instability is created. Volatility is low, confidence is high. Speculative behavior expands quietly. In Phase 2, refinancing becomes selective. Weak structures begin to surface. Problems appear isolated. Confidence becomes fragile. Phase 3 is Minsky's moment. Refinancing fails. Assets are sold to meet obligations. Correlations move together. After liquidation, leverage is reduced. Financing quality improves. The system stabilizes again, but only after clearing. Minsky explains vulnerability. He explains why calm deserves scrutiny and why leverage matters more than sentiment. Minsky does not time markets. He does not predict catalysts. He explains structure, not schedules. The current environment shows late cycle traits: extended stability, high reliance on refinancing, confidence in continued liquidity support. In our strategy terms, this aligns with late Phase 1 moving toward Phase 2. That raises fragility, not certainty. This framework increases caution during calm periods. It raises sensitivity to credit and refinancing stress, and it reinforces confirmation over prediction. If this way of thinking is useful, consider subscribing. Not for forecasts, but to stay grounded in structure, sequencing, and risk as conditions evolve. Quick note here, this is educational commentary only. It is not financial advice. This does not justify panic, it does not force immediate action, and it does not override signal discipline. Refinancing conditions, credit spreads, liquidity plumbing, rates and term premium behavior. Stability is not safety. Stability changes behavior. Behavior increases leverage. Leverage creates fragility. We do not need to be early, we just cannot afford to be late.